Trideep Bhattacharya is CIO-Equities at Edelwiess Mutual Fund. He is now joining us. Trideep, hi, good afternoon. What a strong market. What is this market sensing? I mean, that's just ignoring the global risk off. And it's not just that, we are falling less than global. I mean, we're not even falling, we're rising and at a very fast pace.
Absolutely. I think in the very near term, the market is probably rejoicing the fact that the oil has corrected a good bit in the last few sessions. But I think more generally, if you look at over the last three odd months, we're sitting on a 15% plus rally on the back of a weak global backdrop. So I think there is, in general, appreciation of the fact that the local micro is looking a lot better than the global macro, and relative to the other regional peers, the buy the cheap market hasn't really worked. It's basically wherever the earnings have been more resilient is where the markets are more resilient that way. So I think, yes, I agree with you that in some of the pockets, while global weakness is not being fully appreciated, the domestic cyclicals part of the Indian economy, which is the dominant part, is doing well, and in my opinion, will continue to do well on a relative basis for sure.
Right. Hi, Trideep. The domestic economy seems to be recovery. And in fact, the banking names are doing very, very well. I'm just going through your portfolio construct. You have it, have a mix of both. The larger names, like the ICICI banks, HDFCs of the world, and also smaller names, whether it's a federal bank, which in fact has been in focus. Do you think there is a wave of consolidation that could take place, in the banking space? As it is, credit growth is good, burst of asset quality seems to be behind. But wanted your comment on this.
So I think we are in probably the early stages of a capex cycle where the capex related lending is probably yet to come in. I think when that comes in, probably it'll in all earnest, it'll probably be next fiscal year. But as it starts to show, you will really see some of these banking share prices do well, in my opinion, as compared to what they should. At the moment, they are the only place in the market where you see absolute value as well. So clearly, we are meaningfully overweight, the lending financials, particularly as part of the market, and we expect it to do well. With regards to consolidation, my sense is that at the moment, the lot of consolidation has already happened. From here on, you might see a little bit more of broad-based growth, more broad-based credit growth from where it is over the next 1 to 2 years. And whether it is larger banks or the smaller banks, all of them will see some bit of this demand flow through them. We hope to own, obviously, the best of them, which is what you said is there and thereabouts in the portfolio.
Okay, the Nifty is now trading above 17,800. Why that is important is because 17,800 remains the area where you have the highest calls. Remember, the last stop for the market was 17,800, and today, despite the market's rally, 17,800 call premium is actually down even now, and that's because this amount of open interest over there is 1.32 crore shares. That's just massive. 16 rupees premium right now, 14 rupees. I don't know if that will be taken out. Maybe, you never know, but for now 17,800 is almost here on the Nifty. So Trideep, in the broader market, what are the themes that you are backing now, and the kind of money that you get, what kind of stocks are you adding?
So basically, we think in the near term, the market is more a relative value market, but we are constructive on equity markets from a 2 to 3 year perspective. And the areas that we are bullish on are, number one, we are biased for a rebound in credit growth, which is what I talked about. And this would be driven by a private sector investment demand. So we are overweight industrials, capital goods in a meaningful way in our portfolio. We are also overweight direct and indirect plays on household capex, which is the real estate part. We think that we are somewhere in the first 2 to 3 years of a 7-year real estate cycle, and they should stand to benefit. And off late, we have turned a little more positive on consumer companies, where we think there is pricing power coming through. Because as we go through the back half of the year, we think that some of this commodity inflation, as it cools away, might mean a bit of tailwind for these companies, as opposed to headwinds that they have been facing for the last 6-9 months.
Trideep, what about the pharma space? No one's talking about it. It doesn't seem to be a hot sector any longer. In your portfolio, you have a few of them. You have Sun Pharma, I think, Gland Pharma, there's JB Chemicals as well, among the few names that I could spot. Your view on the space out here, and how would you approach it? The worst of pricing in the United States, is it behind? Give us your sense.
My sense is that broadly pharma is stocks exposed to the US and domestic, and within that the US exposed pharma players have not really seen the bottom. In other words, aligning with the US weakness, there might be some more weakness in the prices in US exposed stocks overall from a pharma perspective. From a domestic pharma names point of view, we are selectively positive on some names, and that's what we are overweight on. On net balance, we'll probably be neutralish on the sector, with more oriented towards domestic rather than the US plays, is what I would point to you at the moment.
Okay, that's on pharma. What about mid-cap IT, Trideep? That is an area where the market's now a bit concerned about whether, there will be a lot of margin pressure from this quarter on, and whether there will be more valuation reset.
Great question. I would actually be less worried on margins. I would be more worried on what they say on the top line, if you really ask me. I think the margin worry has well played out and well understood over the last 2 or 3 quarters that what we have seen. I think the street in general is waiting to hear that what happens to Indian companies' revenue growth for this year or maybe further out, as some of the US companies have started profit warning over the last month or so. And in that context, Accenture results would probably be a bellwether for in general for the sector, particularly in mid-cap IT, because mid-cap IT used to be the place which used to give the growth proxy in the context of the IT services per se. So on net balance, we are actually not so positive on mid-cap IT as yet, even though the stocks have corrected, because we think that the revenue weakness is yet to be fully priced in with regards to expectations in general.
Okay, all right. Trideep, what about the cement space? That's, I don't know, these stocks are just moving in one direction. The recovery I get, the larger names will do pretty well. The problem is that, some of these smaller names, the mid-cap companies, they may not ultimately get acquired, which in that case, it could be putting investors in a bit of a spot. How do you approach this theme?
Absolutely, well spotted. I would say that we are selective in this. So we are, as you said, that we are overweight on some of the larger names which would benefit, even though there is a new entrant in the sector who might, just to make his presence felt, get a little aggressive this way, that way. And if it were to happen, then clearly the smaller names might be in a spot of bother. Hence, we prefer at the moment the larger pan-India plays and relative pockets wherever we see less capacity and more pricing discipline coming through. So we are approaching this with a bit of selectivity in our mind, and we think that we will continue to remain that way. It's unlikely to change, given that the sectoral dynamics from new player entry and how that will behave is not yet clear. Clearly, the stocks have not done well, and hence a little bit of euphoria, some good news makes the stock buoyant from a very near-term standpoint. But I think over a period of time, at some levels, again, the sector-related worries like the new entrant and what they will do to the pricing discipline will emanate. And hence, we are selective in this space.
Okay, selective in the space. Trideep, so to your mind now, what is the big risk to this market? Do you think this market could just make new all-time highs pretty soon and make much higher highs, or is this a market where you would be a bit cautious now on margin?
I would say that the risk to the margin lies actually from a negative headline outside of India. So any tension potentially on China, Taiwan could potentially be something that the market is yet to factor it in. Likewise, a bigger sort of rate hike than anticipated in the United States could also spell a bit of a correction. But I would say that those kind of fears are there or thereabout. China, Taiwan could be an incremental place to be worried about. I think as we go towards the end of the year, the festive demand and the fact that this will be the first year where there is no COVID, or people are out in the open to the extent that they can, will lead to certain resilience in certain pockets of the economy, and hence the domestic bottom-up data would be positive. The worry could be that if the gas prices, or for that matter, any tensions on the geopolitics side, keeps us down. So, given basically strong bottom up and weak macro, that is where I think a bit of complacency might step in. But I would use that weakness to get in. I think from the next 3 to 5 year perspective, you will see the India domestic story, India economic recovery story, and Indian market story being particularly strong. Wouldn't bet against that.
Okay, Trideep, always good hearing your thoughts. Thanks so much for stopping by and filling us in with your views on a whole host of sectors that we just discussed. Wishing you a good evening ahead. By the way, keep an eye on the markets. We're moving towards that 17,000